Disclaimer.
What if I told you there's a mathematical deadline built into our financial system that no politician wants to talk about? Not a conspiracy theory, not a prediction, an actual threshold written into economic history where countries lose control of their money entirely. And we just crossed it. Right now, our government is paying $11 billion per week just in interest on our national debt. Think about that for a moment. Every 7 days, while you're planning your grocery budget and watching gas prices, Washington sends $11 billion to bondholders around the world. That's more than we spend on education, more than we spend on veterans' benefits, and it represents 15% of every dollar our federal government collects in taxes. 1 out of every $7 you send to the IRS doesn't build roads, doesn't fund schools, doesn't even pay down the principal on what we owe. It just covers the interest bill. Here's where this gets personal for your portfolio. In 2025, gold didn't just go up a little bit. It exploded 73% to hit $4,560 per ounce, shattering every record in the history books. Silver did something even more dramatic, surging 169% to reach $78. Now, you might be thinking these are just typical bull market moves, maybe some inflation fears or geopolitical tensions driving scared money into safe havens. But what if these metals are telling us something much bigger about the mathematical corner our economy is backing itself into? Pop quiz. When was the last time you heard a Treasury Secretary announce plans to monetize the asset side of the balance sheet? That exact phrase appeared in an executive order signed in February 2025 by Treasury Secretary Scott Bessent. Sounds like boring financial jargon, right? Except those assets include $762 billion worth of gold sitting in Fort Knox and other federal vaults. Our government is openly discussing how to turn the nation's gold reserves into cash to help manage a debt crisis that's spiraling beyond traditional solutions. Let me put this in perspective with a number that should grab our attention. We're now carrying $38.4 trillion in total federal debt. That's trillion with a T. If you started counting $1 per second the moment Christopher Columbus landed in the Americas, you still wouldn't have reached $38 trillion by today. The number is so massive it stops meaning anything to most people. So let's focus on what actually matters, the cost of carrying that debt. According to the Congressional Joint Economic Committee's latest debt report, we're now spending about 5% of our entire economic output just covering interest payments on what we borrowed, 5% of GDP. Economic historians have identified a crucial pattern across centuries of government debt crises. When a country's interest payments cross somewhere between 4 and 6% of GDP, something fundamental breaks in their monetary policy. They lose the ability to make independent decisions about their currency. The math starts making the decisions for them. Think about what happened to Britain in the 1800s, the British Empire at its peak, ruling a quarter of the globe, commanding the world's reserve currency and the most powerful navy ever assembled. Yet, when their interest payments hit this same threshold relative to their economy, they faced a choice that wasn't really a choice at all. Either destroy their currency through inflation to make the debt manageable, or watch their empire's financing collapse under its own weight. History shows us they chose the former, and the pound sterling never fully recovered its dominant position. We've just entered that same mathematical danger zone. And here's the twist that makes December 2025 so significant. The Federal Reserve, after spending the last few years talking tough about fighting inflation and keeping rates elevated, quietly started buying Treasury bonds again. It's $40 billion worth of government debt purchases, announced almost casually in their December statement. You know what that's called in plain English? Money printing. The Fed is creating new dollars to buy government IOUs because someone has to, and there aren't enough natural buyers willing to absorb the tsunami of debt we're issuing. But wait, you might be thinking, didn't the Fed just cut interest rates to help manage this situation? Yes, they did. 3 cuts this year, bringing rates down to a range of 3.5 to 3.75%. Sounds reasonable until you realize what happened during those cuts. Governor Stephen Murin actually voted for a 50 basis point reduction. That is a half percentage point, while other Fed officials wanted no cuts at all. That's not typical disagreement about economic data. That's a central bank deeply divided about whether we are on a sustainable path or heading toward a cliff. Here's what makes this different from every other debt scare you've heard about over the years. This isn't about the absolute size of the debt, scary as that number is. This is about the structure of that debt and how quickly it responds to interest rate changes. The average duration of all our government borrowing has fallen below 60 months for the first time in modern history. That means the majority of what we owe needs to be refinanced within the next 5 years. Imagine your mortgage worked this way. Instead of locking in a 30-year fixed rate, you had to renegotiate the interest rate every few years, based on whatever rates the market was offering at that moment. When rates are low, you're fine. But when rates go up, like they did dramatically from 2022 to 2024, your monthly payment explodes almost overnight. That's exactly what's happening to our government's finances right now. The numbers tell the story with brutal clarity. Back in 2015, when our debt was only around $18 trillion, we paid roughly $400 billion annually in interest. Fast forward to 2025, and we're paying $981 billion per year. Our debt didn't even triple during that period. It roughly doubled. But the interest cost more than doubled because rates went up and because so much of our debt is short-term, forcing us to refinance at these higher rates. Now consider what gold and silver have been doing while this debt structure was quietly changing. These aren't stocks that go up because a company invented something revolutionary. These aren't cryptocurrencies driven by hype and hope. These are physical metals that have served as money for 5,000 years, and they're screaming at record volumes that something fundamental is shifting in the global monetary system. According to the World Gold Council, central banks around the world bought more gold in 2025 than any year on record. Not just any central banks. We're talking about the smart money institutions that manage trillions in reserves and employ hundreds of economists who see data we don't. China opened competing precious metals exchanges to challenge London and New York's traditional dominance in price setting. In the physical silver market, premiums in China hit levels that dealers hadn't seen even when silver reached its previous peak, showing demand so intense that buyers are paying significantly above spot prices just to secure actual metal. You know what all these official institutions are doing? They're looking at the same math we're looking at. They're reading the same debt reports from the Congressional Budget Office. They're watching the Fed restart its bond purchases despite claiming it won't tolerate inflation. And they're converting paper currencies into physical metal as fast as they can acquire it, because they understand where this mathematical progression leads. The question isn't whether this debt structure is sustainable. The math has already answered that question. The real question is what happens next, and how quickly it unfolds. When you cross from 4% of GDP on interest payments to 5%, you enter a zone where governments throughout history have had to make dramatic choices about their currency. When you combine that threshold with a Federal Reserve that's resumed creating money to buy government debt, with the Treasury Secretary openly discussing monetizing gold reserves, and with global institutions racing to accumulate physical precious metals at record prices, you're watching the early stages of something that accelerates in ways most people don't see coming until it's already happened. Let's talk about what happens when a government's debt becomes so short-term that every move by the central bank directly hits the national budget within months instead of years. This isn't theoretical economics. This is the reality we're living in right now, and the numbers prove it with mathematical precision. Remember when the Federal Reserve could raise or lower interest rates and it would take years for the full impact to ripple through the economy? Those days are gone. With our average debt duration now below 60 months, we've created a financial system where more than half of what our government owes will need to be refinanced before 2030. Every single rate decision the Fed makes shows up in Treasury as budget projections almost immediately. Here's how this played out in real dollars over the past decade. In 2015, when interest rates were near zero after the financial crisis, our government was paying about $400 billion annually to service roughly $18 trillion in debt. That worked out to an average interest rate around 2.2%. Not great for savers, but manageable for a heavily indebted government. Federal Reserve data shows the weighted average interest rate on government debt stayed below 2.5% for most of that period. Then, rates started rising, not dramatically at first, but persistently. By 2024, the Fed had pushed its benchmark rate above 5% to fight inflation. And here's where the short duration of our debt became a mathematical trap. As each Treasury bond matured, as each T-bill came due for refinancing, the government had to issue new debt at these much higher rates. The average interest rate on all outstanding federal debt climbed from around 2% to over 3.5% in just 2 years. Do the math on that shift. 3.5% interest on $38 trillion equals $1.33 trillion annually. But we're not quite there yet, because the debt we issued at lower rates a few years ago is still outstanding, bringing our current weighted average down. According to the Congressional Budget Office's latest projections, we're paying $981 billion this year. That's more than double what we paid in 2015, while the debt itself only doubled. The brutal efficiency of compound interest working against us, accelerated by short-term debt that constantly refinances at whatever rate the market demands. Now think about what this means for the Federal Reserve's independence. For decades, the Fed could make decisions about interest rates based purely on economic conditions, inflation, unemployment, growth. But when your interest costs are growing faster than your tax revenue, when you're spending 15% of the budget just on interest payments, the Fed's decisions suddenly become existential questions about government solvency, rather than academic debates about optimal monetary policy. This is exactly what the December 2025 Federal Reserve meeting revealed to anyone paying close attention. The official statement announced three things simultaneously. And the contradiction between them tells you everything you need to know about the impossible position they're in. First, they cut rates by 25 basis points, bringing the target range down to 3.5 to 3.75%. Second, they characterize this as a hawkish cut, suggesting they were done easing and ready to hold steady or even raise rates again if inflation picked up. Third, buried in the technical details, they announced the resumption of $40 billion in Treasury bill purchases. Let me explain why that third item contradicts everything else. When the Fed buys Treasury bills, it's not using money it saved from previous operations. It's creating new money, electronically, to purchase government debt. This is the mechanism that drove inflation concerns during the pandemic, when the Fed expanded its balance sheet by several trillion dollars. They spent years from 2022 to 2024 trying to reverse that expansion, letting bonds mature without replacing them, shrinking their balance sheet to prove they were serious about fighting inflation. And now, in December 2025, they reversed course and started buying again. Why would they do this? Because someone has to buy the debt we're issuing, and there isn't enough natural demand. Foreign governments are reducing their treasury holdings. China has been a net seller for years. And domestic banks are increasingly wary of loading up on long-term government bonds when inflation remains a concern. The Bank for International Settlements data shows foreign official holdings of U.S. Treasuries peaked in 2021 and have been declining since, forcing the Fed back into the market as the buyer of last resort. But here's where it gets really interesting. The vote wasn't unanimous. Governor Stephen Miran, a relatively new appointment, voted for a 50 basis point cut, twice what they actually did. Meanwhile, several other Fed officials reportedly preferred no cut at all, arguing that inflation risks were still too high to justify easing. This wasn't a minor disagreement about decimal points. This was a fundamental split about whether we're facing an inflation crisis that requires tight money or a debt crisis that requires loose money. You can't fight both simultaneously, and the Fed is discovering that the debt math is starting to override the inflation concerns. Think about the position this puts them in. If they keep rates elevated to control inflation, the government's interest costs spiral upward, consuming an ever larger share of tax revenue and requiring even more debt issuance to cover the gap. Federal debt is growing by about $6.12 billion every single day right now. Not because of new spending programs, but simply because interest costs exceed revenue and the gap gets financed with more borrowing. But if they cut rates aggressively to reduce the government's debt service costs, they risk reigniting the inflation that took years to bring under control, destroying the purchasing power of everyone's savings and salaries. This is the classic debt trap that economic historians recognize immediately. Once your interest payments cross that 4 to 6% of GDP threshold, you no longer have good options. You only have bad options and worse options. The math starts dictating policy instead of policymakers making independent decisions based on economic conditions. Now let's look at who's been paying attention to this math. Not retail investors watching CNBC, not people checking their 401k balances once a quarter. The people moving first are the ones who manage billions and have access to the same Treasury Department data we're discussing. Central banks purchased record amounts of gold in 2025, according to World Gold Council figures. We're talking about institutions that move slowly, that plan in decades, that employ hundreds of PhD economists to analyze scenarios. These aren't impulsive traders chasing momentum. These are the most conservative financial institutions on Earth, and they are converting paper currency reserves into physical metal as fast as markets can absorb the purchases without causing prices to spike too dramatically. China made an even more strategic move. They established new precious metals exchanges in Shanghai and Shenzhen designed to compete directly with the London bullion market and the COMEX in New York. Why does this matter? Because whoever controls the exchanges where gold and silver are priced effectively controls the reference point for global value. For decades, prices set in London and New York determined what the metals were worth everywhere else. Now China is creating parallel pricing mechanisms backed by physical delivery, potentially fragmenting the global market and reducing Western influence over these critical price benchmarks. Then there's the physical demand story that doesn't make headlines, but reveals everything about what is really happening. In China, silver premiums, the amount buyers pay above the official spot price to actually get metal in hand, hit record levels even with silver at $78 per ounce. Premiums are what you pay for the privilege of taking physical possession instead of just owning paper contracts that promise delivery. When premiums spike, it means physical supply is tight, that buyers don't trust paper claims anymore, that they want actual metal they can hold regardless of the cost. This is completely different from what typically happens in bull markets. Usually when prices soar, demand cools off because buyers wait for pullbacks. The fact that premiums are expanding at record prices tells you this isn't speculative momentum. This is institutions and sophisticated investors securing physical supply before they believe a major monetary transition occurs. They are paying whatever it takes to get real metal because they don't believe paper promises will be honored when the debt math reaches its inevitable conclusion. JP Morgan, one of the largest bullion banks in the world, released price forecasts in late 2025 that should have shocked more people than it did. They are projecting gold above $5,000 and silver potentially reaching triple digits within the next 12 to 18 months. Coming from a major bank that traditionally publishes conservative estimates, these targets represent a recognition that something fundamental is changing in monetary metals. They're not calling for these prices because they're gold bugs or conspiracy theorists. They're modeling what happens when the debt dynamics we've been discussing force central banks into positions where currency debasement becomes the only mathematically viable option. The mining supply response confirms this isn't a normal commodity cycle. Despite record prices for both gold and silver, new mine production isn't ramping up the way it should. Mining companies are reporting that it takes 7 to 10 years to bring new major deposits into production, and many promising projects remain undeveloped because capital costs and permitting challenges make them economically questionable even at current prices. This means supply is relatively fixed for the next several years regardless of price, while demand from central banks and institutional buyers continues accelerating. According to the Silver Institute's latest supply and demand report, industrial demand for silver continues growing as solar panels, electric vehicles, and electronics manufacturing consume increasing quantities. At the same time, investment demand is surging as the monetary debasement story becomes harder to ignore. You've got both industrial users who need the metal for manufacturing and investors who want it as monetary insurance competing for relatively fixed supply. That's the classic recipe for sustained price increases that break through previous resistance levels. What makes December 2025 particularly significant is that multiple data points converge simultaneously. The Fed restarting bond purchases while claiming to be hawkish, Treasury openly discussing monetizing gold reserves through the Sovereign Wealth Fund initiative, central bank gold buying hitting records, China establishing competing pricing mechanisms, physical premiums spiking despite record prices. These aren't isolated events. They're different symptoms of the same underlying mathematical reality about debt sustainability. The average American watching mainstream financial news might think everything is fine because the stock market is still near all-time highs and unemployment remains relatively low. But the bond market, where the real power players operate, is telling a completely different story. Treasury yields have been volatile and unpredictable, with sudden spikes that force the Fed to intervene, followed by rapid declines as recession fears resurface. This volatility in government bond yields, the supposed safest asset in the financial system, reveals deep uncertainty about how this debt situation resolves. History provides clear precedents for what happens next. We don't have to guess or speculate. We can look at Britain in the 19th century, at France in the 18th century, at Rome in the 3rd century. The pattern repeats with remarkable consistency. When government debt service crosses certain thresholds relative to economic output, when short-term borrowing dominates the debt structure, when central banks start monetizing government borrowing directly, the math leads to one inevitable outcome. The currency loses purchasing power, sometimes slowly, sometimes rapidly, but always directionally downward. And the assets that preserve value through these transitions are the ones that can't be printed, that have maintained purchasing power through dozens of previous monetary crises, that governments and central banks themselves hold as ultimate reserves. We're watching this play out in real time in our country with mathematical precision that should concern everyone who holds dollar-denominated assets as their primary store of wealth. Now, let's do the math that no one in Washington wants to discuss publicly, but everyone in Treasury and the Federal Reserve is calculating privately. We're adding $6.12 billion to the national debt every single day. Not during crises, not during wars, but right now as the normal course of operations. That's $2.23 trillion per year at the current pace, which means we'll cross $39 trillion in total debt sometime around March 2026. Think about what that means combined with everything we've just discussed. We're already spending 5% of GDP on interest payments with debt at $38.4 trillion. Add another $1 trillion, and we're looking at interest costs approaching $1.1 trillion annually if rates stay where they are. That's close to 6% of GDP purely on interest. The upper end of that historical threshold where governments lose monetary independence entirely. Here's where the math becomes unavoidable. The Federal Reserve has exactly two choices, and only two choices, and neither one is good. Choice 1, keep interest rates at current levels around 3.5 to 3.75%. Watch government interest costs spiral to consume an ever larger share of tax revenue, and accept that within 2 to 3 years, we'll be spending more on interest than we spend on national defense, Medicare, or Social Security. That path leads to a debt spiral, where interest on the debt becomes the fastest growing category in the federal budget, eventually forcing emergency measures anyway. Choice 2, cut interest rates aggressively, potentially back toward zero or even into negative territory like Europe experimented with, to reduce the government's debt service burden. This is the path of least resistance mathematically, the one that postpones the crisis and gives politicians breathing room. But it comes with consequences that everyone holding dollars needs to understand. When you cut rates to near zero on 38 to 39 trillion in debt, you are effectively admitting that the debt can only be serviced through financial repression, forcing savers and bondholders to accept returns below inflation, slowly eroding the real value of what they're owed. Now connect this to what Treasury Secretary Bessent announced in that February 2025 executive order. The Sovereign Wealth Fund initiative isn't just about managing federal assets more efficiently. According to the Congressional Budget Office's analysis, the federal government holds approximately $5.7 trillion in assets that could theoretically be monetized, restructured, or leveraged. This includes everything from federal land and mineral rights to strategic petroleum reserves to our official gold holdings valued at $762 billion using current market prices. When a Treasury Secretary starts talking about monetizing the asset side of the balance sheet, they're preparing the public for something that would have been unthinkable a generation ago, turning the government to strategic reserves, including gold that's been held since the 1930s, into liquid resources to help manage the debt burden. You know what that signals? It signals that the traditional tools aren't working anymore, that the debt math has progressed beyond what normal fiscal and monetary policy can address. JP Morgan's forecast of gold above $5,000 and silver potentially hitting $100 is not coming from optimistic gold bugs. It's coming from analysts who are modeling what happens when the Fed has no choice but to cut rates aggressively while simultaneously creating money to buy government debt. Every major bank runs these scenarios. They plug in the debt growth rates, the interest rate sensitivities, the political constraints, and the mathematical outputs keep pointing toward the same conclusion. Significant currency debasement becomes unavoidable, and the metals that can't be printed respond accordingly. Let me give you specific timeframes based on how this unfolds mathematically. We hit 39 trillion in debt around March 2026. The federal fiscal year ends in September 2026, which means Treasury will be preparing its annual debt sustainability analysis over the summer. The Congressional Budget Office will be updating its 10-year projections, showing debt to GDP ratios and interest cost projections that become increasingly alarming. By the second or third quarter of 2026, the policy shift becomes undeniable because the numbers literally don't work anymore at current interest rates. The Fed can try to maintain its hawkish rhetoric through the first half of 2026, but watch what they do, not what they say. They've already restarted Treasury purchases in December 2025. If that $40 billion per month continues or accelerates, that's money printing, regardless of what they call it officially. And when money printing resumes at scale, while interest rates get cut to reduce government debt service, gold and silver respond the way they always have throughout monetary history. They preserve purchasing power while paper currency loses it. Here's what should really concern you about timing. Gold went from $2,000 to $4,560 in roughly 2 years, from 2023 to 2025. That's a gain of $2,560, or about 107%. That seems like a massive move, and it is by normal standards. But history shows that the final acceleration phase happens after the general public understands what's occurring, after the policy shift becomes obvious enough that mainstream investors can no longer ignore it. The move from $1,000 to $2,000 took gold nearly a decade. The move from $2,000 to $4,500 took just 2 years. The next move of similar magnitude could happen in months, once the recognition spreads beyond central banks and sophisticated institutions to the broader investing public. According to recent investment surveys, retail investors are currently 43% underweight precious metals compared to historical allocation norms. That's a technical way of saying that regular people, the ones managing their own retirement accounts and making their own investment decisions, are dramatically underexposed to gold and silver relative to how investors were positioned during previous monetary uncertainty periods. When that allocation gap closes, when retail investors start moving even a fraction of their stock and bond holdings into precious metals, the supply situation becomes critical. Remember what we discussed about mining supply. New production can't respond quickly, even at record prices. It takes the better part of a decade to go from discovering a major deposit to actually producing metal at commercial scale. The Silver Institute estimates total mine supply increasing by maybe 2 to 3% annually over the next several years. Meanwhile, if retail investors globally shift just 5% of their portfolios toward precious metals to match historical norms, that represents demand for physical metal that exceeds annual mine production multiple times over. This is why physical premiums in China are already at record levels, even with silver at $78. The smart money understands supply constraints. They're securing physical metal now, before the broader public recognizes the mathematical inevitability of what's coming. They're paying premiums that would seem irrational in a normal market because they're modeling scenarios where physical metal becomes genuinely difficult to acquire at any price once the policy shift becomes undeniable and millions of investors simultaneously try to position themselves. Trump's sovereign wealth fund proposal adds another layer to this timeline. If the government seriously pursues monetizing federal assets, including gold reserves, that action itself becomes a massive signal to markets about debt sustainability. Governments don't sell their gold reserves when everything is fine. They sell gold when they're desperate for liquidity, when debt servicing has become so burdensome that they're willing to liquidate strategic assets their predecessors accumulated over generations. The announcement of such sales, even before actual transactions occur, would trigger the recognition event that accelerates precious metals prices as investors realize the depth of the problem. But here's the twist that makes this different from pessimistic doom scenarios. This isn't about the end of America or the collapse of our economy. This is about the mathematical reality that our debt structure is unsustainable at current interest rates, and the policy response to that reality will involve significant currency debasement. That's not a catastrophe if you understand it and position accordingly. That's just a transfer of purchasing power from dollar-denominated assets to hard assets that maintain value through monetary transitions. The empowering part of understanding this timeline is that you have information most people won't recognize until it's already reflected in prices. You understand why gold hit 4,560 and silver hit 78 in 2025. You understand why the Fed restarted bond purchases despite hawkish rhetoric. You understand why Treasury is discussing asset monetization. You understand why central banks globally are converting reserves into physical metal at record pace. All of these pieces point to the same mathematical conclusion about what happens in 2026 when the debt math forces decisive policy action. The critical decision you face is whether to position before that recognition spreads to the broader public or to wait until the policy shift is so obvious that everyone understands it simultaneously and prices have already adjusted. History is quite clear about which approach preserves more purchasing power. The people who recognized Britain's debt dynamics in the 1800s before the currency debasement accelerated, the people who understood Germany's debt situation in the 1920s before hyperinflation struck. The people who saw the US abandon the gold standard in 1971 and positioned accordingly, these weren't pessimists nor doomers. They were realists who understood mathematical inevitability and acted on that understanding, while assets were still reasonably priced. We're at a similar inflection point right now. The math says we hit 39 trillion in March 2026. The structure of that debt, with average duration below 60 months, means every rate decision impacts government finances immediately. The Fed has already restarted money printing through Treasury purchases. The Treasury Secretary has already announced plans to monetize federal assets. Central banks have already positioned aggressively in gold. The framework for what happens next isn't speculation, it's mathematical progression. The question is whether you recognize this progression early, while most investors remain 43% underweight. Precious metals and mining supply remains constrained regardless of price. Or whether you wait until the second and third quarters of 2026 when the policy shift becomes undeniable and everyone tries to position simultaneously. The math doesn't care about your political preferences or your optimism about America's future. The math just progresses according to the rules of compound interest and debt dynamics that have governed every monetary system in human history. Gold at 5,000 and silver at 100 aren't predictions requiring crystal balls. They're mathematical projections based on debt service ratios, interest rate paths, money supply growth, and historical precedents for how metals respond when governments choose currency debasement over debt default. The timeline converges around mid-2026 because that's when the annual budget process, the debt ceiling discussions, and the mathematical reality of unsustainable interest costs all force decisive policy action. You now understand what the smartest institutions in the world have been positioning for throughout 2025. You understand why the metals surged to records while most investors remained underallocated. You understand the timeline and the mathematical drivers that make significant further gains not just possible, but mathematically probable, given the debt dynamics in play. What you do with that, understanding how you position your own finances and investments, that's the decision that determines whether you preserve purchasing power through what's coming or watch it erode along with everyone who did not pay attention to the debt math until it was too late.